But let's face it, the reality is it when you have a turnover, it's very expensive. So you gotta factor that in. And I put up here on a slide one little thing that I think is important to understand in real estate investing, and that's leverage. Cash on cash and ROI are two different formulas, two different ways to look at a potential property to buy. This is pretty stable, pretty predictable, and it's a 36% return on your investment.
We were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you could build on. I'm your host, Kevin Amolsch. Here we are. We're back with another solo episode of the Real Estate Educators Podcast, and I am going to have a slideshow presentation, a little visual aid in this one, because I want to go through some real estate investing formulas. This is going to be probably pretty important for newer real estate investors, but also more sophisticated investors. Something that we don't always look at is the different formulas we should be using in our analysis and what properties we should buy, what properties we should keep. So I want to go through that. And I think my slideshow is sharing currently. So I'm just going to roll with this here. I think this is going to be challenging for if you're just listening in, if you're tuning in your car or something like that. You might want to go back and check out this episode on the YouTube channel. YouTube, again, is youtube.com/Pine Financial. That's where you'll find the visuals for this podcast episode. But I'm going to try to go slowly so that even if you are driving and you're not watching on YouTube, you could still get a good grasp of what the concepts I'm trying to teach here. And I think this will really help you. So let's get started with real estate investing formulas. There's many different formulas that you could be using when you're looking at real estate deals. So the first one is cash on cash. So this is your cash on cash return. I think this might be the second most important formula, maybe the first, to be quite honest with you, because cash flow on your real estate holdings, your long-term holdings, is pretty essential for longevity in this business. I say this all the time, but there's profitable companies that go out of business. And the reason for that is because they don't manage their cash flow. And not having the liquidity and not having the reserves, and then obviously not having the positive cash flow to withstand any of the storms that come. Real estate is a great example of a business that can go out of business and be profitable because we leverage real estate. So let's say you have $100,000 loan and every month you make a payment. Well, part of that payment goes to interest and part of that payment goes to principal. Well, that piece that goes to principal does not go in your pocket, right? It goes back to the lender. But that is not an expense. You cannot write that off. That is considered profit for you, even though you're not getting the benefit of that profit. So real estate, great example of cash flow being absolutely essential for longevity. So cash on cash return is what we're going to look at here first. And the way you calculate this cash on cash return on a potential investment is your cash flow, and then you divide that by your investment amount. So cash flow can be, or your monthly cash flow, your net cash flow can be a bit elusive because there's things like vacancies that don't happen every month, or a water heater might go out and that might take out rent for a month, or you might have a turnover that is an expensive turnover. Maybe the tenant didn't take care of the problem or the property and created a problem for you. So I know we get security deposits and that, but sometimes the security deposit is not enough to cover the damage that a tenant will cause. So that's why I'm saying it's that cash flow can be a little bit elusive. So we want to be pretty conservative in our estimates on those non-monthly, non-reoccurring expenses. So I like to use, a pretty aggressive vacancy factor. I'm typically using around 5%. That I'm going to budget in for my vacancies. My vacancies over the entire portfolio is significantly less than that. But when I'm running my numbers, I'd like to use a 5%. And then for maintenance, it really depends on the asset, the property condition at the time you're renting it out, and how large it is. So let me give you an example. If you have an apartment building and you have a lot of common area, your maintenance is going to be much higher than a little single family home, or even a condo where you have an HOA that takes care of a lot of the common area maintenance stuff. So really pay attention to what type of property you have, and then your percentage to budget for your maintenance will vary. So let's say we're going to use a single family home in this example. That's most common. Most listeners are single family home investors. So a single family home, detached, no HOA, no one taking care of anything. You have to take care of it all. Now you could shift some of this to the tenant. Like let's say you're going to do a rent to own and say, hey, they got to take care of some of the maintenance. So there is ways to shift some maintenance liability to the tenant, but let's just pretend you're the landlord. You're going to take care of all of it. I would typically budget 10 to 15% of my gross rent and maintenance expenses. In a larger apartment where there's lots of common area, you're probably closer to 30% in maintenance. And I know some people are going to push back on that. They don't like to hear that maintenance is actually that high. And especially if you're looking to buy a property, the seller will never admit that their maintenance cost is that high. But let's face it, the reality is when you have a turnover, it's very expensive. So you gotta factor that in. A lot of times on the larger projects, we do a loss reserve or a reserve to replace. Reserve to replace would be, I'm going to put $100 a month every month so that when the furnace goes out, I have the money to fix it. Okay, reserve to replace in a commercial building is typically about 1.5%. And that's again of your gross revenue or your scheduled rent. I don't typically do that in the single family home space because what I've found is if I'm 10, 15% in my maintenance expenses, that does cover those larger expenses as well. Okay, so now we're trying to get to the net cash flow, rent amount minus vacancies minus rent, and then any other expenses that you might have like utility bills and taxes, insurance, if it's not included in your mortgage, that kind of thing. Make sure all of that gets deducted, and that final amount, that's your cash flow. Now, we want to annualize the return. So we annualize the cash flow first. So your monthly net cash flow times 12 is your annual cash return divided by your investment. So in an example here that if you're watching, you can see it up on your screen. I'm going to say we're buying a house and we want $500 a month in net cash flow. That's our criteria. That's what we're buying. So if we have $500 a month in positive cash flow, and let's say we're buying a $250,000 house and we have a $50,000 down payment. So I'm going to be very, very simple here. Nothing creative. We teach you how to do no money down transactions on the YouTube channel, on this podcast. So you could definitely find ways to reduce your down payment. But in this example, I'm just going to be very, very traditional, 20% down payment, go to the bank, get a loan, just buy something that's already cash flowing. So we're going to have to spend 50 grand to get that $500 per month. So we're buying that cash flow. Okay, $6,000. If you multiply that by 12 divided by 50. Okay, I'm going to slow down here. Remember, net cash flow times 12 to annualize it, 500 times 12. That gives us $6,000 per year in income. Divide by my investment of 50 grand. That gives me a 12% return. That's 12% cash on cash. That's not your net return. We're going to go over that in a minute. Cash on cash, 12%. And I put up here on a slide one little thing that I think is important to understand in real estate investing, and that's leverage. If I was able to use a BRRRR strategy or get in with some owner carry, some owner financing, some type of other creative strategy, I could potentially reduce my down payment. If I'm reducing it down to, let's say, $20,000, which is not that hard to do, that's $6,000 a month divided by an only $20,000 investment, shoot your return to 30%. So I only wanted to share that with you because you could see when you can reduce your down payment, how significant that will be on your overall cash on cash return. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help.
We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
Okay, the next formula, and this is where people get tripped up, you guys. Cash on cash and ROI are two different formulas, two different ways to look at a potential property to buy. Return on investment, ROI, is going to be your total return divided by your investment. So we already knew the cash flow. We just went through that. But what else is included in your return on rental properties? Well, you have appreciation because the house value is going up over time. And you have principal reduction because your tenant's paying off your mortgage for you. So as I mentioned earlier with the cash flow management thing, every month you make a payment, some of that goes towards paying down the loan. So that is profit for you, as I mentioned before. So we have to count that in our total return, even though it's not going into our pocket. So I have up on my screen an example. Same example, actually, as I just used, and it's a $250,000 house, and I'm going to assume a 4% appreciation. Over the long term, if you're, I mean, wherever you go and look at this stuff, guys, it's so different, but typically you're around 5% return if you're looking at a long-term appreciation. Now, if you take out 2008, you're probably closer to 7 or 8% long-term. And a lot of people believe that 2008 was an anomaly. And even if we have softening, it's not going to be to that degree. I don't disagree with that necessarily, but we also had an anomaly in 2020 and 2021 with a record amount of government stimulus, which shot the prices of homes through the roof too. It was like 17% appreciation, which that's not normal either. So to be fair, we want to capture both the downs and the ups. So you're looking around 5%. So in this example, I'm going to use just a 4% return. I think you can count on that in the long run. Yeah, and I'm using a 7% interest rate, which is very close to what it is as of today when I'm recording this. I'm not exactly sure when this will be released, so that will be different than it is right now. But as of now, it's about 7%. So what I did was I ran the 7% mortgage rate on a 30-year through an amortization schedule to come up with my loan paydown numbers. So it's actual numbers from an amortization schedule. So again, we're going to have cash flow of $6,000, which we talked about earlier. You're going to have your appreciation of $10,000, which doesn't seem like a lot, but that's year one, right? So $10,000 increase in value because of a 4% on 250,000. Okay, now we have a principal reduction of 2,000. It's actually a tad higher than this. I'm just rounding here a little bit. But we have the $6,000 cash flow. You have a $10,000 in increase in property value, and you have $2,000 off of your mortgage in the very first year. And what I'm not mentioning here, guys, is this is year one. We do know that there's a compound effect on both the appreciation and principal reduction. So the next year, now I'm getting a 4% return on 260,000 instead of the 250 because it went up to 10, right? So our appreciation is on a bigger number year 2 and 3 and 4. So there's an exponential growth, just meaning it gains more faster the further along you go in time. And then the principal reduction has the exact effect in the opposite direction. You're paying down the mortgage more quickly each and every year. So 2,000 will be the lowest. Maybe it's 2,400 year 2 or 2,300, whatever that number is, year 2. And then it's more the year after that. So you're going to be increasing the velocity of your wealth with real estate investing. So a total of 18,000, if I add all of those numbers together, 6,000 plus 10,000 plus 2,000 equals $18,000 in total return. Divide that by my $50,000 down payment, and you get a 36% return. I think this is very important to understand. And this is one of the reasons I really love real estate investing and why I think it's better than any other investment out there. Obviously, there's other investments that could produce even higher, but there's a significant amount of risk with that. Like cryptocurrency is a great example. Buying Tesla stock is a great example. But this is pretty stable, pretty predictable, and it's a 36% return on your investment if we're looking at the property strictly through an ROI perspective. Okay, the next one is cap rate. And this, gosh, you Google this term and it's going to be all over the internet. This is a very, very common way to look at properties when you get to above 4 units. So 5 units or higher, or any commercial assets, always look at cap rates. So a cap rate is, think of it like this. It's the return the property produces, assuming there's no leverage. So if you have a $100,000 property and it produces $10,000 net operating income, that's your net cash flow basically before debt, that's going to be a 10 cap. So a 10% return with no leverage. When you layer in leverage, that could actually benefit or hurt you, which we'll look at. Okay, so in this, I'm giving you a different example. Let's say we're going to be looking at a small apartment building and it produces $100,000 NOI. NOI is your scheduled income minus all your vacancies, minus all your management fees, minus all your taxes, insurance, maintenance, all of your expenses comes down to one final number, and that's your NOI, net operating income. So NOI divided by investment. In this case, 100,000, we paid a 1.5 million for the building. That would give us a 6.7% return on your investment. That's pretty close to what you're going to be finding if you're buying properties right now today. 6-7% cap is probably where you should be buying. Okay, so that's how I came up with these numbers. This is obviously just all made up, but to give you an idea of what it should look like in today's market. Okay, I put on here, also used to value real estate. So cap rates are a fantastic way to analyze a property. So you should be targeting certain cap rates when you're buying. Again, because that's the return on unleveraged property, but it's used to value the property also. All you have to do is change the formula around. Instead of NOI divided by price, you would do NOI divided by the cap, and then it would give you the value. So in this exact information, if I'm trying to come up with a value of the property, and I know what the NOI is, and I know what the cap rate is, I would do $100,000 in NOI divided by 6.7% cap rate, and that would give me my value of 1.5 million. So again, I went really fast there. You calculate cap rate by NOI, net operating income, divided by price you're paying for the building. That gives you your cap rate. You can get the value of a building using the cap rate as well. That formula is NOI divided by your cap rate. So then the question comes in sometimes, okay, I want to value a commercial building, and I got the financial, so I know the NOI, but how do I know the cap rate? Well, the cap rate, that's where comps come in. It's not just some number you pull out of the air. It's what other people are paying for buildings in that area, similar buildings, class A, B, or C. So you want to get similar buildings and what they're trading for in that market. That's what investors are demanding in a cap rate or in a return. And that's the cap rate you use to value the property. All right. So yeah, interesting, right? Instead of comping solds like you do in single family homes, you comp cap rates and use that for the value. Okay, what I want to talk about quickly is negative leverage, because we're seeing this a little bit right now with interest rates so high. So what negative leverage means is your cap rate is lower than the leverage rate. So if I go out and get a loan, that interest rate on that loan is higher than what my cap rate is. And that's negative leverage and can be very, very dangerous. So in this example, I'm going to use 20% down payment, and I'm going to use a 7% interest rate, and I'm going to use that exact same example of the 6.7% cap rate. So we have a 7% note rate, 6.7% cap rate. They're very close, but the cap rate is under the leverage rate. So this is where you can create some problems. So in this example here, we have a 25-year amortization loan, which is very common in commercial at 7%. So I have an NOI of $100,000, which we talked about, and I have payment of $101,800. Okay, so I'm losing $1,800 per year, pretty close to break even, but I'm losing $1,800 a year. 18 bucks divided by my investment. I use a $300,000 investment because remember the purchase price is 1.5 million in this example. So a $300,000 investment. My return on that cash on cash return 0.6% negative. So I'm losing money because of the negative leverage. Now here's where it gets interesting. And this is why normally when you bring in leverage, you are shifting risk to the lender because they're putting in a chunk of money, you're putting in a chunk of money. It's not all your money at risk, right? Now your credit's at risk, but it's not all your cash. The bank is taking some risk as well. So typically you would, with the lower down payment, you also should see a higher return. We've seen that over and over and over. In this case, the more money you put in, so the more risk you're taking, actually, that's good. The more risk you're taking, the higher the return is. But the leverage amount, the more your down payment is, you would think would increase your returns, and it decreases. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.